Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Ben Jones, product development specialist with Nasdaq Index Research, for an overview of recent market activity and how different factors are performing. Ben, it's great to see you as always. Welcome back to Trade Talks. And let's take a look at your first chart here with a high-level overview of recent market activity.
Yeah, I wanted to show this chart because I think it provides a nice picture of what's been taking place in the marketplace really over the last few months. And that's been the rotation across some of these important U.S. size and style box. And what I'm talking about is, are we seeing a pivot or a transition from growth to value? So what you see here is tracking the average fund score for these different style boxes. So U.S. small value, U.S. large growth as an example. And this is using data from Nasdaq Dorsey Wright. The scale goes from 0 to 6, 6 being the strongest. So it plots those scores over time. What you can see starting on the left-hand side, in let's say early 2020, when we saw the initial COVID-19 correction take place, large growth was the permanent leader, right? It was, kind of leading us in and out of that correction. It was actually quite stable. What really transpired after the 2020 election was all of a sudden growth started to weaken, and you started to see small cap growth funds start to really pick up some momentum. But what's interesting here, Jill, is that we're seeing another change take place where we're starting to see, not only large growth, fall in momentum or fall in strength, but we're seeing the rise of small cap value take place. And we're seeing a transition between small value and small growth. So these are just some of the some of the rotation that we're seeing today. And this has been going on for the last few months. Again, the market's been topsy-turvy, Jekyll and Hyde with yesterday's action versus today's. But overall, if you look at a long-term picture, these are changes that have been taking place for the past few months.
And then if we look at the next slide here, we're setting up the cap strength concept. Explain to us what that is.
Yeah, I want to set this up and introduce this index to everyone watching because, right now I think we're seeing a lot of volatility in the market. We're potentially seeing some, style rotation that we haven't seen for a while now. And so if you have seen portfolios that have been tilting towards growth or tilting towards higher beta areas, advisors might be thinking about, well, what's the other side of the trade? Maybe we need to look at something that's more defensive. And so the capital strength index concept is, kind of typifies defensive equity. It's the combination of two important factors, quality and low volatility. So the definition for quality varies to index provider, asset manager to asset manager, but it basically encompasses companies that are profitable and have low debt or low leverage. So that's what the index starts with. It looks for companies that have at least $1 billion in cash or short-term investments. It looks for companies that have a long-term debt to market cap below 30% and then have a return on equity higher than 15%. So once we have that universe of stocks or companies, we then rank them by their volatility, right? And looking for those companies that are exhibiting low volatility. And this is an index that tracks these top 50 names that are high quality and have low volatility characteristics. This index is tracked by the First Trust Capital Strength ETF, FTCS. And so what this gives you is an index that is comprised of companies and industries that are very different than traditional value indexes or strategies, as well as traditional market cap or even growth indexes. Right now, this index is roughly about 10% technology. When you're, let's say, the Nasdaq US 500 large cap index is nearly 30% technology. This index is about a 28% weighting towards industrials and consumer goods at 21%, and that's where it's overweight, which is very different than, let's say, what you might get from your traditional market cap-based indexes. And so that's why it is different. It uses that quality and low volatility screen, and that gives you a very different index than what you might get from some of the competition out there or what you might be using for core exposure.
And Ben, what about if you're looking for something with more defensive characteristics?
Yeah, and so this is what it provides. This is part of the story with the capital strength index. So what we looked at was basically kind of a modified downside capture. We looked at periods in which, let's say, a broad market benchmark corrected 10%, and we wanted to see how the capital strength index performed during those periods. And what we found is that for most of the 10% corrections or so, the index held up better than the market, right? It had only about an 84% downside capture, which means that it is quite defensive and holds up better than traditional, let's say, beta type indexes. So it can provide some downside protection when we see these styles of corrections. Now, again, it doesn't do that for every correction or every volatile move in the market, but at least for 84% of the time, it held up better than the benchmark we were looking at. So it does provide some defensive downside protection That's primarily because it's going to be allocating towards high quality companies, as well as companies that have, lower standard deviations from a historical standpoint.
And Ben, let's wrap with factor combination. What different types of categories are you looking at?
Right. So how do we apply this concept in portfolios? So we see a lot of advisors, looking to use an index like this, as core exposure. We also see, some practical uses for combining it with other factors, right? Some of the best diversification benefits come from allocating towards strategies that zig when the market zags. And so if we look at the capital strength index, we see that it actually has a negative excess correlation of returns to value and growth, two styles that you typically see asset allocators overweighting to or using most frequently. So you see some diversification benefits of the capital strength concept with growth, right, which has been the preeminent part of this narrative in the last few years, as well as value. This is very similar to what you see with traditional strategies with that classic trade of momentum and value, having really strong negative correlations to one another. We see that with value and growth with the capital strength concept. So, if you're looking to see where this complements, where the capital strength index complements, it's with value and growth, and those are two factors that stand out.
All right, Ben, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.